Most people don't feel anything is wrong yet. Markets are open, liquidity is still there, headlines are loud enough to feel reassuring, but the important signals are no longer in the headlines. They're in how capital is behaving, quietly, defensively, and ahead of the narrative. The US dollar just came through one of its weakest sustained periods in more than a decade, not because of panic, not because of a single crisis, but because the market has started reassessing assumptions it hasn't questioned in generations. This is not a story about collapse, it's a story about repricing. And repricing always happens before permission is granted to talk about it. Through 2025, the dollar weakened broadly, not against one rival, but across developed and emerging currencies at the same time. That should not happen in a system that still enjoys unquestioned dominance. It happens when confidence becomes conditional. Debt has compounded. Deficits have normalized. Policy has become less predictable. And global capital, the kind that usually doesn't move unless it has to, has begun hedging dollar exposure as a default behavior. That alone tells you the regime is shifting. This moment isn't about the end of the dollar. It's about the end of automatic trust. And January 2026 is where the consequences start becoming harder to ignore. The dollar is being repriced, not rejected. The dollar's recent decline is not a speculative event. It is not the product of a single shock, a single policy decision, or a short-term positioning error. It reflects a structural reassessment that has been building for years and finally reached the point where markets could no longer ignore it. This is what repricing looks like when it is driven by systems rather than sentiment. What matters most is not how far the dollar moved, but how it moved. The weakness was broad, persistent, and sustained across time. It did not express itself as a sudden break or a disorderly unwind. It accumulated quietly. That pattern is consistent with capital adjusting risk assumptions, not traders chasing momentum. Structural repricing is slow by design. It advances without drama because it does not require consensus to function. Breadth is the critical signal. In 2025, the dollar weakened against both developed and emerging currencies simultaneously. That combination should not occur when dominance is intact. In a healthy dominance cycle, relative weakness is localized. Capital rotates between peers. Safe haven demand compensates for imbalances. When weakness becomes synchronized, it signals that the base layer itself is being reevaluated. This shift occurred while the United States remained the world's largest economy, issuer of the dominant reserve currency, and host of the deepest capital markets. Those conditions are normally sufficient to insulate a currency from sustained underperformance. The fact that they did not is the point. The market was not reacting to lost primacy. It was adjusting to narrowing relative advantage and rising conditionality. Repricing always leads recognition. Markets do not wait for narratives to stabilize. They move when assumptions change. Public discussion tends to follow price action, not precede it. By the time repricing becomes a common topic, much of the adjustment has already occurred. That is why the absence of panic is not reassuring, it is characteristic. This is not rejection. There is no mass exit from dollar usage, no collapse in settlement, no abandonment of institutions. The dollar remains central. What has changed is the way it is treated. Dominance once operated by default. It is now subject to evaluation. That distinction matters. Systems do not fail when they lose primacy. They change when trust becomes conditional. Fiscal arithmetic finally entered the currency. For years, U.S. fiscal expansion was treated as a background condition rather than a binding constraint. Debt rose, deficits widened, and markets absorbed the issuance without demanding meaningful compensation. That era has ended. Fiscal arithmetic has moved from the periphery of analysis into the currency itself. The United States crossed a structural threshold long before the dollar responded. Debt growth stopped behaving like an emergency tool and became a permanent feature of the economic model. Deficits no longer narrowed during expansion. They persisted through growth, through strong labor markets, and through rising asset prices. That persistence altered how markets interpret supply. Markets are not moral arbiters. They do not punish governments for borrowing. They price sustainability. When liabilities expand faster than productive capacity for long enough, confidence stops compounding. It plateaus. Once confidence plateaus, price becomes the adjustment mechanism. For decades, U.S. debt expansion was insulated by three factors: global savings demand, reserve currency status, and relative growth outperformance. Those buffers absorbed issuance without forcing the currency to respond. What changed is not that borrowing increased, it is that the buffers weakened simultaneously. Foreign official demand for U.S. debt has slowed at the margin, not collapsed, not reversed, but reduced in relative terms. Domestic buyers and private financial institutions have absorbed more issuance. That shift matters because it changes the character of demand. Trust-driven demand is stable. Yield-driven demand is conditional. As debt grows, rollover risk increases, not because default is imminent, but because financing becomes more sensitive to rates, inflation expectations, and policy credibility. That sensitivity feeds directly into currency pricing. The dollar does not need to fail for this to matter. It only needs to lose its insulation. Deficits that persist during expansion signal that future downturns will arrive with less fiscal flexibility. Markets understand this arithmetic. They do not debate it, they discount it. Over time, that discount expresses itself through higher compensation requirements, either in yield, currency adjustment, or both. The currency response is not linear. It lags, then accumulates. For years, the dollar absorbed fiscal strain without visible consequence. Once confidence in the trajectory weakened, the adjustment began quietly. This is why the recent move should not be interpreted as a reaction to a single budget cycle or political outcome. It reflects a reassessment of long-term balance. Fiscal dominance does not announce itself. It emerges when monetary policy becomes constrained by the scale of government obligations. Markets do not wait for that constraint to bind fully. They move when they see it approaching. The dollar's repricing is the market acknowledging that fiscal arithmetic is no longer theoretical. It is active. The U.S. growth premium has narrowed. For more than a decade, U.S. growth outperformance acted as a stabilizer for the dollar. Investors accepted currency exposure because returns compensated for it. Strong productivity, resilient consumption, and a dominant technology sector created a persistent premium. That premium justified concentration. It also justified complacency. That condition no longer holds in the same way. The U.S. economy has not weakened dramatically, but its relative advantage has narrowed. Growth has normalized while other regions have stabilized. The gap that once insulated the dollar has compressed, and currencies respond to relative change, not absolute strength. This shift matters because capital allocation. Growth normalization also interacts with fiscal dynamics. When growth slows relative to debt accumulation, sustainability becomes a question of arithmetic rather than optimism. Markets do not assume future acceleration will resolve imbalances. They discount the possibility that it will not. That discount shows up gradually, first in currency behavior. For years, U.S. exceptionalism allowed investors to ignore currency effects. In 2025, many global investors experienced a different outcome. Nominal gains were offset by dollar weakness. Real returns disappointed. That experience recalibrates expectations more effectively than any forecast. Once capital internalizes that returns are no longer uniquely protected by growth, behavior changes, exposure is diversified, risk is priced explicitly. The dollar loses its automatic bid not because it is unattractive, but because it is no longer unrivaled. This is how dominance erodes in practice, not through rejection but through comparison. Growth premiums are powerful when they exist. When they compress, currencies adjust. The market is not signaling the end of U.S. relevance. It is signaling that relevance must now compete rather than default. The dollar's repricing reflects this shift. Relative advantage is narrowing. Capital is responding accordingly. Policy uncertainty has become a currency. Risk for decades, U.S. policy volatility was treated as noise rather than risk. Markets assumed that institutional continuity would override political swings, trade disputes would be resolved, sanctions would be targeted. The system would remain predictable enough for capital to operate without friction. That assumption has weakened. Policy tools that were once exceptional are now routine. Tariffs, sanctions, export controls, and financial restrictions have been normalized as instruments of statecraft. Their use has expanded in frequency and scope. What matters is not the intent behind them, but their effect on risk perception. When policy outcomes become harder to anticipate, currencies absorb the uncertainty. Currency markets are uniquely sensitive to unpredictability. They function as the connective tissue of global finance. When the issuer of the world's reserve currency introduces non-economic risk into that connective tissue, participants adjust behavior. This adjustment does not require disagreement with policy goals. It reflects exposure management. The dollar's role has always rested on more than scale and liquidity. It relied on the assumption that access would remain stable regardless of political alignment. That assumption is now conditional. Financial assets have been frozen, restricted, or rendered inaccessible based on geopolitical decisions. Once that precedent exists, it cannot be unseen. This shift does not require hostility toward the United States to matter. Even allies must consider scenarios where alignment changes or policy priorities shift. Reserve managers and institutional investors are not planning for today's environment. They are planning for stress scenarios. In those scenarios, predictability carries value. As policy uncertainty rises, capital demands compensation. That compensation can take the form of higher yields, diversification, or currency adjustment. In the case of the dollar, diversification has become the preferred response. It is less disruptive and more sustainable than confrontation. The impact of policy uncertainty is cumulative. No single tariff announcement or sanction decision triggers a regime change. Repetition does. Over time, each instance reinforces the perception that exposure carries tail risk. Markets do not debate whether that risk is justified. They price its existence. This dynamic alters capital flows at the margin. Incremental decisions shift first. New allocations are structured differently. Hedging becomes more common. Long-term exposure is evaluated with a wider set of variables. These changes rarely generate headlines, but they reshape the baseline. The dollar remains central to trade, finance, and settlement. That has not changed. What has changed is the way that centrality is interpreted. It is no longer assumed to be neutral. Neutrality is evaluated rather than granted. Policy uncertainty has therefore become a currency variable. It operates quietly alongside fiscal arithmetic and growth convergence. Together, these forces reduce the automatic bid that once supported the dollar. This is not a judgment on policy effectiveness. It is a description of how markets respond when predictability erodes. The repricing underway reflects that response. Hedging behavior signals regime change for decades. Global investors treated dollar exposure as a neutral baseline. Currency risk was largely ignored, not because it was misunderstood, but because it was assumed to be irrelevant. The dollar's role as the dominant reserve and settlement currency made unhedged exposure the default choice. That behavior has changed. Hedging is not an abstract concept, it is a cost. Investors incur that cost only when they believe risk has shifted. In 2025, hedging dollar exposure became more common across institutional portfolios. This was not driven by speculation or fear, it was driven by reassessment. When hedging becomes routine, it signals that a currency is no longer treated as neutral. This change matters because hedged capital behaves differently from unhedged capital. Unhedged exposure is sticky. It tolerates volatility. It assumes long-term stability. Hedged exposure is conditional. It responds more quickly to shifts in policy expectations, volatility, and relative performance. As hedging increases, the character of capital flows changes. The shift toward hedging did not occur in isolation. It followed a period in which currency effects materially altered returns. Many global investors experienced a disconnect between asset performance and realized outcomes once dollar depreciation was accounted for. That experience forces recalibration. Models are adjusted, assumptions are rewritten. Hedging also creates feedback loops. As more investors hedge, currency moves are amplified rather than absorbed. What was once dampened by passive exposure becomes more sensitive to marginal flows. This does not create instability by itself, but it reduces the currency's natural shock absorbers. Importantly, this behavior does not imply a loss of confidence in U.S. assets. Capital has not exited equities or bonds wholesale. Instead, it has changed how exposure is managed. That distinction is critical. Regime change does not require abandonment. It requires conditionality. Once hedging becomes embedded in standard practice, it is rarely reversed quickly. Even if conditions improve, the memory of vulnerability persists. Risk management frameworks evolve slowly, but they do not easily revert. What was once considered unnecessary becomes standard. This evolution weakens the structural bid that supported the dollar for decades. The currency benefited not just from demand, but from indifference. When investors stop caring about currency risk, dominance is reinforced. When they start pricing it, dominance erodes at the margin. The market does not announce this shift, it reveals it through behavior. Hedging volumes, positioning data, and portfolio construction tell the story more clearly than rhetoric. In 2025, those signals aligned. The dollar's repricing is inseparable from this change. When the base layer of global finance is no longer treated as risk-free by default, adjustment follows. Hedging is not the cause, it is the confirmation. Monetary trajectory removed a core support for years. The dollar benefited from a clear and durable rate advantage. U.S. interest rates sat above those of major peers, attracting capital and reinforcing currency strength. That differential acted as a stabilizer. It compensated for fiscal expansion, policy volatility, and external imbalances. As long as the rate premium held, the dollar retained insulation. That support has weakened, not because rates collapsed, but because the trajectory changed. Currency markets do not respond to where policy is today. They respond to where it is expected to go. Once markets concluded that U.S. rates had peaked, the foundation began to shift. Expectations of future easing altered behavior well before any formal decision. This is how monetary transmission works in currency markets. Anticipation matters more than execution. As soon as participants began pricing eventual cuts, the dollar lost a key pillar of support. This adjustment did not require aggressive easing or an immediate policy pivot. It only required the belief that relative tightening was over. Once that belief takes hold, capital recalibrates. Carry trades become less attractive. Rate-driven inflows slow. The marginal buyer demands compensation elsewhere. The importance of this shift lies in its interaction with other pressures. Monetary trajectory alone would not have triggered a structural repricing. In combination with fiscal strain, growth convergence, and policy uncertainty, it removed the final layer of insulation. The dollar no longer enjoyed clear superiority on rates, growth, and predictability at the same time. This does not imply monetary policy failure. The Federal Reserve acted within its mandate. The issue is not policy competence, it is relative positioning. The dollar strengthened for years because U.S. policy diverged positively from peers. As that divergence narrowed, so did the currency's advantage. The critical shift occurred when diversification moved beyond sanctioned governments and into mainstream capital behavior. Central banks, sovereign funds, pension managers, corporations, and private institutions began acting on the same conclusions. This transition from political signaling to market execution is what transforms a trend into a regime change. Markets do not move out of defiance. They move out of necessity. In 2025, many global investors experienced a clear outcome. U.S. assets performed adequately in nominal terms, yet real returns disappointed once currency effects were included. Dollar depreciation eroded purchasing power. That experience mattered more than any speech or policy paper. Once capital internalizes that exposure no longer guarantees protection, assumptions are rewritten. The United States did not become unattractive. It became comparable. That distinction is subtle but decisive. Capital allocates differently when no single destination is treated as uniquely safe. This reassessment is visible inside portfolio construction rather than headlines. Currency risk is now modeled explicitly. Hedging costs are weighed against expected returns. Geopolitical exposure is included alongside traditional financial metrics. These are mechanical adjustments, not ideological ones. As diversification becomes standard practice, concentration becomes harder to justify. Capital rotates rather than accumulates. Marginal allocations shift first. Over time, those marginal decisions reshape the baseline. Structural demand weakens without a single dramatic event. This process also explains why the dollar's decline does not need to be steep to be significant. Persistent, modest reallocation is more powerful than sudden shock. It alters expectations. It resets what is considered normal. Dominance erodes when default choices become optional. Trade settlement reflects the same logic. More transactions are conducted in local currencies or alternative arrangements, not to overthrow the dollar, but to reduce cost and risk. These decisions are pragmatic. They accumulate quietly until infrastructure adapts. The key point is that markets rarely reverse once they adapt. Governments can debate, delay, or reframe. Capital adjusts and moves on. The shift from government-led de-dollarization to market-led diversification marks the point of no easy return. This does not eliminate the dollar's role. It redefines it. The currency remains central, but it is no longer singular. Once markets operate under that assumption, the architecture of global finance changes accordingly. January 2026 is a confirmation window, not a beginning. By the end of 2025, the market had already adjusted its baseline assumptions. The era of automatic dollar strength was no longer taken for granted. What remained unresolved was not direction, but speed. That uncertainty is why the early months of 2026 matter. January concentrates information. Inflation data, labor market reports, central bank communication, and fiscal signaling arrive in a compressed window. When confidence is already conditional, density acts as an amplifier. Markets do not need new causes. They test existing conclusions against fresh evidence. This period is not about reversal. It is about validation. Each data point either reinforces or challenges the emerging regime. Markets are forward-looking systems. They do not wait for full clarity. They adjust positioning as probabilities shift. Inflation data will be interpreted through a different lens. Persistent inflation constrains policy flexibility. Rapid disinflation accelerates easing expectations. Either path pressures the dollar in a system already sensitive to trajectory. The direction of travel matters more than the headline number. Labor market signals will function the same way. Employment has been a pillar of resilience. Any sign of softening does not need to indicate collapse. It only needs to confirm deceleration. Markets adjust on momentum, not absolutes. Federal Reserve communication will be parsed for nuance rather than decisions. Tone, sequencing, and conditional language matter more than rate moves themselves. When credibility is intact but insulation is gone, guidance becomes a currency variable. What makes this window different is that positioning has already shifted. Hedging is in place. Diversification is underway. Reserve behavior has changed. Markets are not starting from neutral. They are testing whether the new assumptions hold. This is why January is not the beginning of the story. It is where consequences become harder to ignore. When repricing begins quietly, it can be dismissed. When confirmation accumulates, it becomes structural. Once markets begin operating under a new regime, they rarely return to the old one unchanged. Even if data surprises temporarily stabilize the dollar, the hierarchy has already shifted. Trust is now conditional. Dominance must be justified rather than assumed. Markets price sequences, not snapshots. Even if rates remain elevated in absolute terms, the direction matters more than the level. Once easing enters the forward path, the currency adjusts to reflect the future state, not the present one. This effect is amplified when fiscal needs are large. As government financing requirements grow, the interaction between rates and currency becomes more sensitive. Lower expected rates reduce the yield cushion available to absorb issuance. That sensitivity feeds back into exchange rates. The result is not sudden weakness, it is gradual erosion. The dollar does not collapse when rate expectations shift. It reprices as one support among many is removed. This process is orderly precisely because it is anticipated. The market response in 2025 reflected this logic. As expectations shifted toward future easing, the dollar adjusted quietly. No announcement was required. The repricing occurred because the system recognized that a long-standing advantage had peaked. Monetary trajectory did not cause the regime change. It confirmed it. Reserve management has turned defensive. For decades, U.S. Treasury securities occupied a singular position in global reserves. They offered liquidity, yield, and an implicit guarantee of accessibility. That combination made them the uncontested core asset for central banks. This hierarchy is no longer absolute. Reserve managers have not abandoned treasuries. They have adjusted their behavior. The shift is incremental, deliberate, and defensive. Incremental exposure has been reduced, diversification has increased. This distinction is essential. Structural change in reserve management rarely occurs through liquidation. It occurs through accumulation decisions that are quietly redirected. What prompted this change is not ideology or protest. It is risk assessment. The freezing and seizure of foreign reserves demonstrated that access to financial assets can be constrained by political decisions. Once that precedent exists, reserve assets are no longer evaluated solely on financial characteristics. They are evaluated on neutrality. Central banks exist to preserve stability under stress. When assets carry legal or political tail risk, concentration becomes a vulnerability, diversification becomes rational. This logic applies regardless of alignment with the United States. Allies and non-aligned states face the same exposure problem. Reserve management is not about current relationships. It is about worst-case scenarios. Gold's resurgence as a reserve asset fits squarely within this framework. It is not a bet against fiat currency. It is not nostalgia. It is insurance. Gold does not depend on any issuer's balance sheet, legal system, or political alignment. It sits outside the system rather than inside it. The rise of gold does not imply a return to a gold-backed monetary regime. Modern economies require monetary flexibility. What has changed is the hierarchy of trust within reserves. Treasuries are no longer treated as the singular anchor. They are one component among several. This adjustment has meaningful implications. When treasuries lose their exclusive role, demand becomes more price-sensitive. Yield matters more than trust. Price-sensitive demand is inherently more volatile. It responds quickly to changes in inflation expectations, policy signals, and fiscal outlooks. Reserve diversification also reduces the structural bid for the dollar. Even small shifts accumulate over time. When the largest and most patient holders of dollar assets reduce incremental exposure, the currency loses a stabilizing force that once operated quietly in the background. This process is deliberately opaque. Reserve managers value discretion. Transparency invites pressure. Undeclared purchases and gradual rebalancing are features, not anomalies. They reflect a desire to prepare without provoking reaction. The dollar remains the largest reserve currency. That fact has not changed. What has changed is how unquestioned that role remains. Reserve management has turned defensive, not confrontational. In a system defined by uncertainty, defense is the rational posture. This shift reinforces the broader repricing underway. It does not announce an end. It signals a recalibration of trust. Market-led diversification replaced political theory. For years, de-dollarization was framed as a political project. It was discussed as an ambition of governments opposed to U.S. influence, driven by ideology rather than economics. That framing is no longer sufficient. What is unfolding now is broader, quieter, and more consequential because it is being led by markets rather than states. The system is not breaking, it is recalibrating. The dollar remains central, but it no longer anchors the entire structure by default. January 2026 will not announce an end. It will